Let's check up on how the Home Run Investor Service has been faring out with editor of the service, Brian Boland. And since you and I spoke about Home Run Investor here, it's been a while and a lot has happened.
Yeah, it's been a difficult year. 2014, we saw a lot of volatility, a lot of ups and downs in the market, and that caused us to, push the panic button here and there. We ended up selling out at the lows for several stocks, and then only to see them move up higher. We did see small cap stocks, which is what Home Run Investor focuses on. They underperformed the market in general. We saw healthcare and utilities lead, and there's not too many utilities that are small caps. They're all large cap dividend payers, slow growth, but the market was looking at 2014 as being more of a defensive year, not being offensive or aggressive. So we were not the area that a lot of investors look to.
All right, so that said, where do we stand now?
Well, the Home Run Investor portfolio right now is aggressively positioned, and that's the way that we kind of like to see it. We like to have names in there that have big betas that are going to move up when the market's moving up. Right now I think that is pretty much the prognosis for the market for the rest of this year and even into next year as well.
What about that QE bazooka that was fired in Europe earlier today?
Right, the bomb went off over in Europe there.
Yeah.
And they're going to be doing their QE, and what that's going to end up doing is stabilizing rates, keeping them nice and low. And when you have low rates, you're going to have a lot of money flowing into the system. It's going to stabilize their banking system, and it's going to help the entire European economy. Anything that helps their economy is pretty much going to help ours.
So what does that mean for someone like you who manages a service like this and is identifying specific types of stocks for this portfolio?
Well, it's going to mean that having European exposure isn't a bad thing, where it has been probably over the last 9 to 12 months. Not necessarily a bad thing, but something that you don't want to be heavily exposed to. So right now that's something that we can open up to, and then also that we look at the idea of interest rates with them staying low. Those stocks that are influenced more by interest rates, those are things that we can take a deeper look at.
All right, so as you said a moment ago, I'm not talking out of school here, you said it, I'm just repeating it, you had some big losers in the portfolio, down 20% or more.
Right.
What are you doing to stabilize that?
And we're trying to limit that, and that idea. So we're talking about tightening up the reins here. We're saying that, usually the mantra is that once a stock goes to negative 20%, we're going to sell it. And that's just going to force us right out, and we're going to eat those losses at negative 20%. Sometimes the stock will go to negative 15% and then recover, and that's what we're hoping for. But at the end of the day, it doesn't happen that much. The thing is that we're going to now look at, moving that stop, that unspoken stop from negative 20 to negative 10%. But here's the rub, and I bring up this slide here to kind of, talk about this. This is a number of stocks here that we have held throughout the year 2014, where we sold them. You can see the returns, ranging from negative 18 or 16% to, up to almost negative 29%. But from the point of that sale, and I took these prices as of today, and today is
22nd of January.
The 22nd of January. So from the 22nd of January, from the point at which we sold these stocks, we can see that a lot of them have severely outperformed, two of which have gone up over 100% from that point. So the idea that I'm trying to bring here on this slide is that patience is what's important in investing. If you give these stocks, even when they're down pretty big, you give them some time, you have the patience. We're picking good stocks, we're not picking bad stocks. If you have patience with them, they can turn out to be winners even after they're down significantly. And I think this slide pretty much proves that out.
Yeah, it's a virtue, by the way.
Yeah, patience is, it's always in a man, never in a woman.
Well, I don't know if I'd say that, but let's look ahead. What do you see looking ahead?
Looking ahead, we've got global interest rates. They're going to remain low. When we have that, we're going to have all sorts of opportunities for, home refinancing, that sort of sector. So banks, particular, are going to be squeezed on the net interest margin, so we're not going to be looking at those end of the financials, maybe more in the mortgage space, because we expect to see refinancings happening there. Biotech is looking to continue to outperform, as is healthcare. I think a lot of money went into that space in 2014. It's going to continue to go there. And then technology, just select technology names. I'm going to be looking for those bigger beta, bigger risk names in technology that have lower prices as well.
All right, well, we're going to check back with you going forward to get some more updates throughout the year. In the meantime, don't forget those updates and commentaries that Brian sends directly to your inbox as a subscriber. With Brian, I'm Terry Ruffalo.